Hello guys, nice to see you around. Okay, I'm doing this because our previous class was not able to hold. My network had issues and I said no, I have to go ahead with this. So this is Law of Banking and Negotiable Instruments. By the end of this class, you would have learned combination of accounts, appropriation of payments, Garnishee orders, overdrafts, and banknotes. The aim of this class is to bring to you circumstances that banker-customer relationship can be tampered with, circumstances when it does not remain as it is supposed to be, when, for example, the regular manner that a relationship between a banker and his customer is ordered turns the other way around. So let's look at all of these one by one, and hopefully we'll be able to understand better what exactly these concepts in the law of banking refer to. The first concept we'll be looking at today is combination of accounts. Now, a number of scholars have described it as a right that a banker has to combine two or more accounts, a right to consolidate two or more accounts, the exercise of a banker's lien, a right of set-off. So these are explanations of what combination of accounts is. Now, what is combination of account? Now, you must know that combination of account is different from combined accounts. The legal term combination of account refers to a process by which a banker is able to combine all accounts kept by a particular customer in the same right, whether in the same branch or in different branches, and this same banker has the right to exercise a lien or set-off for the balance that remains. So what does that mean? Combination of account arises in a situation whereby a banker is able to carry all the accounts belonging to a particular customer, join it together, and from the joining of the running of these accounts together, that banker is able to eliminate, for example, monies that the customer owes the bank. Take, for example, you have an account where you are saving money, and you have another account where is a current account, and these two accounts belong to you. The law is that if you enter an overdraft in your current account and you have money that can pay for the overdraft in your savings account, the banker is well within its right to combine these both accounts, remove the money you are owing them, and then keep the rest for you. It happens in so many places, and it is under different circumstances has the courts come to describe exactly the rules that we have to be followed before a combination of accounts will happen. Usually it is expected that where a banker has an account in different forms, for example, if you are a lawyer and you have a legal practitioner's account, and you are also a private person and you have your own account that you use to run your expenses, it is expected that the bank should treat these two accounts separately, because the monies flowing into the both of them do not go into the same issue, in the sense that the monies in these both accounts are supposed to be dealt with separately, and the banker is under an obligation to keep these bank accounts separate. It is expected that a banker should know that accounts opened in his bank is supposed to be handled separately. It is usually where there is a default of payment, probably in a mortgage or in a loan, and the banker decides to offset this mortgage by going to check for the balance in the customer's accounts in other accounts that he has with him. that is the banker, that combination usually arises. So the question still needs to be resolved, which is combination of accounts the same thing as a right a bank has as a debtor to set off a particular credit it has given to the customer, or is a combination of accounts the same as a lien that belongs to bankers, which is bankers' lien? Can we say that combination of accounts can be defined and be kept together as a right of set-off or banker's lien? So in trying to learn what these are and in trying to understand whether a right of set-off or a banker's lien is the same thing as a combination of accounts, it makes sense to define these concepts. First of all, what is a banker's set-off? Investopedia defines a banker's set-off as a legal clause that gives a lender the authority to seize a debtor's deposits when they default on a loan. A set-off clause can also refer to a settlement of mutual debt between a creditor and a debtor through offsetting transactions claims. Now, what is all this English referring to? Now, when a person enters into a loan agreement with another person, there is always a right in that loan agreement for the creditor to take a property of the debtor and sell in order to realize the monies on his loan. Now, a set-off clause refers to, in a banker's set-off now, when we're referring to bankers now, when we're referring to a banker, it means that a banker can look at a customer's deposits, the account he has with the bank, remove the loan that the customer has from him, it has taken from him, and keep the rest. Now, for the customer, that ability to seize that deposit that the customer has, the money in the customer's account, the balance to which the customer is ordinarily entitled to, that ability to do that when the customer defaults on a loan is referred to as a banker set-off. I hope you know that the fact that I have 1 million in the bank does not mean that I cannot take a loan of 100,000. I can have 1 million in the bank and take a loan of 100,000 naira. You get what I'm saying? So it doesn't mean that the bank will now take the 1 million I have and pay the 100,000. No. The loan agreement is separate from the money I have with the bank. Now, what it means is that the bank can, when I default on paying back, let's say I took 100,000 naira loan from the bank and I'm supposed to pay back 5,000 every month. That 5,000 every month, once I default on it, the banker can, as part of their right through set-off, go into my account, remove the amount of money that takes care of the remainder of their loan, and that will be in exercise of their rights to set off. Now, if, for example, we are talking about a different arrangement other than a banker-customer relationship, if you take a loan from me to buy a car, and I know you bought a car with my loan, we can have, as part of my set-off, the fact that if you refuse to pay me back my loan, I can take your vehicle and sell it. Selling your vehicle is me setting off the money you have with me. So bankers will not sell your property, especially, for example, you have some amounts of money with them. They will instead remove the money from your deposit. In situations where a person does not have deposits with the bank, the banker can go ahead to move towards the deposits, that is the securities that were used to take a loan, the properties that serve as security, whether as collateral or anything. Selling those properties that serve as security for a loan is a banker's right of set-off. What is a banker's lien? A banker's lien is an enforceable right of a bank to hold in its possession any money or property belonging to a customer and to apply it to the repayment of any outstanding debt owed to the bank, provided that, to the bank's knowledge, such property is not part of a trust fund or already burdened with other debts. What does this mean? If, for example, you are owing the bank 100,000 naira and your balance in the bank comes down to 100,000, it will be stupid for the bank to continue to allow you to use your credit when, for example, you've come to the limit of what it is you owe them. So they have the right to say, no, we will not give you monies up to this a particular amount of money that we have with us to spend, because this is the amount that we are hoping to use to return the loan that we gave you. Let me explain this in very simple terms. Imagine that somebody owes you 200 naira and that person comes to your house and is charging his phone. When he finishes charging his phone, he takes his phone and wants to leave. You can say, no, I will not give you your phone until you give me the money you owe me. You're exercising a lien. Of course, you will not buy the phone. The phone is not your own. You have no intention of selling the phone. What you are doing is you are withholding the phone until the person that owes you is able to return the money they've taken from you. So it is stated here that the money that the bank is using as a lien, right, must not be part of a trust fund and must not have already been marked out for other debts. That is to say that, to the bank's knowledge, if the bank knows that the money in this particular account is created for a particular, is held by this customer to the benefit of another person, it will be unwise for the bank to hold on to that money and say they are exercising a lien on it. Why? Because the money does not belong to the customer that is actually owing them. There are other debts that money is burdened with. So where am I going with this? When you look at these rights and you look at what we define as combination of accounts, you examine both of them side by side and you see that both the banker's set-off, a banker's lien, are different concepts from what a combination of accounts means. Now, what are the things that can determine whether a bank can combine a customer's account? The first thing is the character of the account. What is the nature of this account that the customer who is now a debtor has with the creditor who is now the bank? If, for example, as I've explained, you as a banker have somebody who is owing you money and he has two accounts. Take me, for example, I run a foundation. My foundation has an account to the bank, and I also have a private account to the bank. It is not wise and it is illegal for the bank to take money that is being used to run an organization, an account opened for an organization, and use the loan that I've taken privately from my own one-on-one dealing with them and use the money from the foundation to pay those loans. Some of you are leaders in student organizations. If you take a loan from the bank on your personal accord, the bank is not going to say, oh, this person is a signatory to this account. I am going to take money from the account of the organization which is serving as a signatory to the account and pay back the loan that this person is holding. Why? Because the character of the account is different. Now, there are very doctrinal disputes which Igwe in his book takes care of, and I urge you to look that up. The second thing is the character of the customer. In what circumstance is this customer having to open this account? Take, for example, this customer may be a private individual in this first account, and in this second account, his character has changed. He's now the director general of an agency. There is a case in the textbook where you find a customer who is the MD of a company who has taken a loan in his private account, and the bank went ahead to combine the account, and in so doing set off the money that he's being owed from the organization that is serving as an MD's account. And the court held that that kind of circumstance, right, was impossible to do. Now, another thing that is a factor that courts look into when deciding on whether a combination of accounts is legal or not is whether this account is held in different branches of the bank. Now, in the olden days, as I said, due to the analog ways of doing things, branches of banks played a pivotal role in deciding how a person would be able to access the services of a bank. But today, using BVN and every other thing, bank accounts have actually been settled across board. Now, what does this mean? This means that today, having branches, opening your account in a branch in, let's say, Kafanchan, does not mean that the bank does not know that you are still the same person who has these two accounts with them, right? So this is a moot point as far as modern life goes. And this leads us to a question. Do you think opening an account in different branches of a bank today will significantly impact on a customer's rights? The answer is, of course, no. But in those days, it did, because a bank account opened in some other place may have different rules. You may have opened a savings account with a particular branch. With this particular branch, you're opening a current account. And the mandate you have with the bank and the different branches are different, even though it is still the same bank. And this significantly impacts on what a customer's rights used to be in those days. But today, everything has been digitized. At a call of a button, your details are in every branch that you walk into. So as of today, your opening of a bank account in a separate branch of a bank will not significantly impact on your rights. So, having understood what combination of account means, which is the combining of the monies in two or more accounts of a particular customer in order to set off the loan that he has in a particular with a transaction he has done with a particular account. So how will combination of accounts happen in real life? Which is, if for example I have a savings account in my name and a current account in my name, and I take a loan on the savings account and I have more money on the current account. In fact, the courts have ruled that there is a right on the banker to join these two accounts together, remove the amount of money I have taken on my savings account as loan, and retain the rest for me. By removing the amount of money, they are exercising what is known as the right of set-off. But that is different from the mere exercise of the right of set-off itself, or the mere exercise of a right of LIEN. Do you understand? Combination of account involves set-off within it, but it is not set-off, it just involves it. So we are now in appropriation of payments. Appropriation of payment is also known as the rule in Clayton's case. Now, what does it mean? The allocation of one or more payments to one particular debt out of several owed by a debtor to the same creditor. The power of allocation belongs in the first instance to the debtor, but if he does not make an appropriation at the time of payment, then the creditor may do so. How does this happen? Now, if, for example, you are owing a bank, let's say you've taken several loans from a bank. You took 100,000 facility, took a 200,000 facility, took a 300,000 facility, 200, 300, 500, 200, 300, 500. You took 3 different facilities from a bank, and then you are paying it back, right? However, remember you first took 200, and the time for 200 to elapse is coming, right? And the 200 loan, 200,000 naira loan you took, you gave your car as a collateral. The 300,000 naira loan you took, you gave your wife's car as collateral. The 500,000 loan you took, you used your land in the village as collateral. The first one to be due is your 200,000 naira loan. The second one to be due is your 300,000 naira loan. The last to be due is your 500,000 naira loan. And as you're paying back these loans one after the other, you realize that one is becoming due faster than another. And then one day you decide to give the bank 200,000. Now, in your mind, you believe that you are just trying to offset the loan that is more time yours, but you did not communicate this intention to the bank. What is going to happen is that the bank is going to take that money and decide which of these loans it will regard as paying back. Now, the bank can take that loan from you, that money you've come to give them, and say they are using it to offset the 500,000 naira loan. So for that your 500,000 naira loan, it's now remaining 300,000, and then sell your car because your loan is due on this first payment. Now, it is for the wise debtor to come to bank and communicate what exactly the money he's giving the bank, which particular facility he's trying to pay that money into. Otherwise, the bank decides which ledger. There is credit and debit ledger. Once the money comes in, they fix it here. Once the money comes in, they fix it here. They can by themselves decide where they can allocate this money you are paying into. Now, in the case of current accounts, without any other express appropriation, that is, if you do not expressly communicate your wish to the bank, payments are normally appropriated to the oldest outstanding debt. That is to say, if you had a current account and you have taken several facilities on that current account, facilities now refer to credit facilities. If the bank has given you either a loan or a revolving credit or an overdraft, these are three things you can take from a bank: a loan, an overdraft, a revolving credit. And you've taken several of it on top of a particular account. The law is that payments are appropriated to the oldest debt. So you can have 1 million and say, oh, I want to just offset this last 1 million, but that's not how the bank is going to interpret it. The bank is going to take the money and pay back the oldest debt you have, pay back the second one before they decide to pay back the one that is most recent. So if you as a customer wish to avoid the consequences of the rule in Clayton's case, you should endeavor to decide for yourself and communicate that decision to the bank. That is the particular amount of money you are paying back. Going forward, Garnishee orders. What are Garnishee orders? A Garnishee order is an order made by a competent court attaching a debt that is being owed or accruing from a third party to a judgment debtor in satisfaction of the debt of the judgment creditor. Now, this is too much English. Let us explain this. There are three parties to a Garnishee. The first party is referred to as a judgment creditor. The judgment creditor is the person that has gone to court and the court has given an order. You are supposed to be paid so and so money by this person. So let's say Mr. A and Mr. B. Mr. A has gone to court against Mr. B, and the court have said, Mr. B, you must pay Mr. A particular sum of money. So if we use two things to eliminate them, Mr. B owes Mr. A money because the court said Mr. B should pay Mr. A money. So these two parties are looking at each other. B owe money, A is being owed money to. Judgment creditor, judgment debtor. Judgment creditor, judgment debtor. So let me now put this to hand. Let's do it like this. So there is a fist and there is a hand. Okay. So creditor, debtor, creditor, debtor. So what does this mean? The judgment creditor now goes to court because he knows that the judgment debtor has money in a bank. He goes to court to say, court, stop this man from using his account, because I want him to use that money that is in his account to pay me the debt he has owed me, the judgment debt he's owing me. So, the bank is on their own. Nothing concerns them. Suddenly they get an order. Do not transact business with this particular customer because he's owing somebody a judgment debt. That sudden order that is given without even the judgment debtor knowing is referred to as a Garnishee or NIEC. That is, it is usually ex parte. The other party is not even aware. So he now realizes, oh, I can't transfer money with my bank account. What is going on? I'm going to see my bank. He calls them on the phone. The bank says, no, we just got a Garnishee order to stop paying money to you until you come and defend yourself in a case that you are a judgment debtor in. So when he goes to court to defend himself and he loses, the court makes the NIEC order absolute. What does an absolute Garnishee order mean? An absolute Garnishee order means that the judgment debtor must now surrender the amount of money that is required to pay off his debt, all of them. So a NIEC order is interim. That means it is within a dispute and attaches immediately when it is made. When it is final, it is executable. That is to say, all the monies are transferred to the other party. A Garnishee order is an order of court. This is a second definition, obtained by a judgment creditor, directed to attach the money of his judgment debtor, which is in the hands of a third party. Now, you must know that it's not all the time that a bank is the third party here. Sometimes the money you are being owed is money that you are, let's say, if Clinton was going to collect money for doing a business with somebody, and I know that money belongs to him, I can use this Garnishee order to stop the person that is supposed to pay him that 1 million naira and pay it to me that he's owing. Right? So the effect is that the third party is prevented from paying the money so attached to anybody, but to hold it as a custodian of the court until the court gives directives as to how the money is to be applied. The third party is called the Garnishee. That is the one that is commanded, and the money attached will invariably be applied to satisfy the judgment debt. So court is literally, a Garnishee order is literally a court telling somebody that wants to pay somebody he's owing, do not pay that money until we tell you what to do with that money. This one I've described now is Garnishee order NIEC. Garnishee order absolute is take that money and give to this person that is being owed by this other person. It arises in two ways. The first way is keep the money until we tell you what to do. Second way is this is what we want you to use the money and do. Satisfy the judgment debt. Is that okay? So that is how it happens. There are rules for Garnishee and there are nomenclature of parties. The first party you have to know about is a judgment debtor, who is the bank's customer. The judgment creditor, who is applying to court for the Garnishee order to be served on a person who is owing the judgment debtor. That is the bank. Now, you must realize that why this is able to happen is because the relationship between a banker and a customer is a debtor-creditor relationship. The bank is a customer's debtor. So the bank is somebody that is supposed to give you money that it is owing you whenever you want it. So instead of giving you that money, the bank now gives that money to somebody you are owing through a garnishee. The banker is called the third party or garnishee. That is the one commanded. Garnishee, garnisher. So who is the garnisher? The garnisher is the judgment debtor. Who is the garnishee? The garnishee is the third party or the bank, not the debtor. The garnisher is the judgment creditor. The garnishee is the third party. The judgment debtor is not within that framework. Okay? So what are the rules? The rules is that all the balance of the customer's money are attached, except where the account is in debt. So of course, when the account is in debt, the bank is no longer owing you, you are owing the bank. So there is nothing to attach because you are not being owed by the bank. Now, usually once a garnishee or garnish is released, all the money in the bank freezes. You are not allowed to withdraw from the bank. You are not allowed to make any transfers from the bank. It freezes, right? Until it is made absolute. Either the order is quashed or it becomes absolute and you actually have to pay the money. So you cannot take that money if the account is in debit. Okay? Money held for another person or in trust can be attached as far as the money is held to the customer's credit and can be withdrawn. Now, what does this mean? Unlike when we talked about combination of accounts, if, for example, you are holding money in trust for another person and you can benefit from that money, let's say you're a legal practitioner, and in that legal practitioner's account, you have some monies that belong to you, the money that is supposed to be paid you for the job you did. It will be attached because some of that money is yours, is coming to you. The order must correctly identify the judgment creditor, otherwise the bank will be entitled to ignore it. If, for example, my name is Sopruchi and you bring another for Uncle Sop, that is also my name, but that's not my formal name. You go to the bank says we don't know this dude, we've never seen this person in our life. The bank will, of course, ignore that kind of order. Only money owed to the customer at the time of service of the order is attached. That is to say, if you serve me the order today and tomorrow I get 100 million. You can't say, oh, no, I want to attach the 100 million too. No. That one that was there, the 2,000 naira that was there when you served the order, is all that will be attached to the account. Now, usually, when their money is attached, it is kept in a separate account where nobody can tamper with it. And usually also, it is the amount of money that is being owed the judgment creditor that can be attached. Let's take, for example, if I'm owing you 2,000 naira, and of course in my account, you know I have like over 1 billion naira in it. So the bank will remove the 2,000, keep it in check, and allow me to still be using the remainder of my balance. So only that one that is being owed you at the time of service of the order is attached. That is just your money, nothing else. It doesn't stop me from spending any other money. It just stops that particular amount that is your property. Also, only money which could be conclusively said as already paid from the account will not be attached, provided the payment of such money or its effective transfer has been completed at the time of serving the order. That is to say, if you do a transfer through all these NEFT, right? NEFT is a transfer that has to stay for 3 days. NEFT is different from NIP. Okay? If you do a NEFT transfer, it takes 2 days, 3 days to show up. You should know this in case the police stop you on the road and say, give us money. Don't use NIP. Use NEFT. NEFT takes some time. So when you leave that place, you can call your bank to reverse that transaction. Okay? So only money which has been said to be conclusively paid from the account will not be attached. If the judgment debtor had written a check to somebody who has not gone back to cash it, that person cannot say, oh no, this judgment debtor's money, some of it is my own because I have a check. No. If any amount of money has not left the account, the transfer is ineffective. The other also cannot attach to a joint account because, as you have learned from a joint account during our last class, you deal with a joint account together. You cannot separate one party from a joint account. Okay, there are other rules. I will send you a material that you will read to know the other rules involved in Garnishee. What is an overdraft? An overdraft is an extension of credit from a lending institution that is granted when an account reaches zero. So what does this mean? If, for example, your account with a bank reaches zero, if the bank extends its service of credit to you, what it is giving to you then is an overdraft. It is different from a loan. Why? Because in a loan, you actually have to sit down and sign documents. The documents have to decide how much you are going to pay back, how the bank will take its money back, and usually loans are for a very big sum of money. Overdrafts are just for a little over the amount of money you have, more like a credit extension of the bank that allows you to take money to a particular level. Overdraft is also different from a revolving credit in the sense that a revolving credit is a special version of a bank loan where you are given a credit limit. The bank says, okay, even if you finish all you have with us, you can spend money up to this particular amount. It looks like an overdraft, but it's not. It looks like an overdraft, but it's not. It's just a special version of a bank loan. That is another type of bank loan, but you are given a limit to spend, right? Whenever you draw on that revolving credit, it reduces. When you pay it back, it goes back to what it is. So if the bank gives you 2,000 naira as a credit, revolving credit, you spend 1,500 out of it, you now have a 500 naira revolving credit remaining. You remove that one, you have a social amount of money revolving pro tanto. If you pay back the money, your credit limit also increases. That is different from an overdraft. An overdraft is when there is nothing in your bank account. You've been spending money and the bank gives you further extension of credit, allows you to continue taking money from it. Okay. So finally we come to banknotes, which is paper money. It constitutes, now there is a reason why I inserted this definition for you. Banknote is a piece of money constituting a central bank's promise to pay a stated sum to the bearer on demand. So, what do you see from here? The money you give to the bank is the bank taking the promise of the central bank that when they, the bank, submit this piece of paper to them in central bank, they will give them an amount of money. Do you understand what I'm saying? So, if the bank has 100 naira notes from 500 people, it's 500,000. That means 500,000 credits will be given to the bank from the central bank. So I hope your understanding of what paper money and banknote is shifting. So somebody says it's a negotiable promissory note which one party can use to pay another party a specific amount of money. A banknote is payable to the bearer on demand, and the amount payable is apparent on the face of the note. Banknotes are considered legal tender along with coins. They make up all the bearer forms of all modern money. Banknotes are not the only form of money we have, but they are a very, very substantial part of money in 21st century. And as I've said, many countries now do not secure their banknotes with a particular value. It is fiat money in the sense that it's money that is not real money. And there is a consequence of an economy that keeps printing money without creating value. Let's say, for example, people are complaining that Nigeria does not have any money, Nigeria can't pay its workers. Imagine that Nigeria just goes and prints more currency. After all, it's Nigeria, so Nigeria just prints more currency. Imagine that. What do you think will happen? When, for example, there is no value attached to that currency that is being printed, it's just giving people money. What will happen is that people will use that money and buy things, right? And when, for example, the real economy plays out, inflation is going to come into play because that value is not going into anything. However, where a country, for example, creates a mining sector that begins to do things that the government can bankroll, it is better and creates a more solid economy than just handing out money because it's fiat money and we can print it. Do you understand? So reasonable economies know, countries that have working economies know that they cannot just afford to be printing money and be sending money out just like that. So this is where we come to the end of our class. It was short, okay, because it's basically me talking into a system. Okay, no response, no feedback, but I hope you've learned something. If, for example, you listen to all of this and you have any questions before your presentations tomorrow, please let me know. I'll be glad to hear all of it. So thank you so much.